Hello everyone and welcome to today's Mondac webinar in association with Capital Law and an expert panel who will provide valuable insights into the Economic Crime and Corporate Transparency Act of 2023 and how business professionals can stay ahead of the changes and remain compliant. My name is Charlie Greenhead and I'm joined by a brilliant panel to take us through today's discussion. Philippa Ellis is a partner at Capital Law, where she leads the Business Crime and Investigations team. She joined from the Serious Fraud Office, where she spent 6 years leading complex investigations into large-scale fraud, bribery, and corruption involving both corporates and individuals. At Capital, Philippa and her team advise clients on how to manage and mitigate financial crime risks, including bribery, fraud, and money laundering. Paul Chadwick is a forensic accountant investigator with Capital Law and has nearly 20 years experience in white-collar investigations, primarily in matters of fraud, bribery, corruption, false accounting, and money laundering. He joined Capital Law from the Serious Fraud Office, where he led multidisciplinary teams of investigators, lawyers, and accountants, and was involved in investigations and prosecutions of a variety of high-profile and complex financial crimes. Anna McIntyre is a senior associate at Capital Law. Anna is a former Serious Fraud Office case controller and prosecutor, where she spent more than 5 years at the SFO, leading multiple investigations and prosecutions of serious financial crime before joining Capital Law in November 2024. She brings extensive experience from both the private and public sectors in the investigation and prosecution of white-collar and economic crime. Before I hand over to Philippa, Paul, and Anna to begin today's webinar, a quick housekeeping item. You can submit questions for the panel by typing them into the questions pane of the toolbar on the right-hand side of your page. They will endeavour to answer as many questions as possible during the Q&A session, but please do reach out to them after the webinar for additional information. It's now my pleasure to hand you over to Philippa, Paul, and Anna to begin. Thank you.
Thank you to Charlie for that wonderful introduction, and thank you to all of you for taking the time out of your day to join us. Before we get started, I'd just like to ask you to consider how confident you are that your organisation is prepared for the significant and wide-ranging changes brought about by the Economic Crime and Corporate Transparency Act, or ECCTA as we'll be referring to it today. This Act represents one of the most significant overhauls of UK corporate criminal law in decades, and certainly within the span of my career, and it has serious implications for businesses regardless of size or sector. I'm going to provide an overview of ECCTA and will then hand over to my fantastically knowledgeable team to delve into the detail, some tips for compliance, and to run through a couple of case studies. By the end of this session, I sincerely hope you'll feel informed of the major changes and the steps that you can take right now to protect your business. Could we just have the next slide, please? Thank you. The financial crime landscape has significantly increased in its complexity over the last 20 years or so, with the speed of change becoming often difficult to keep pace with. There have been changes to the way fraud and bribery are defined, as well as increased money laundering regulations, particularly for FCA-regulated businesses. There has also been the introduction of specific corporate offences, where an organisation could be held liable for failing to prevent bribery committed by a person associated with their business, a similar offence for failing to prevent tax evasion, and now from September of this year for failing to prevent fraud. But we're also seeing more agencies using the powers at their disposal to investigate and prosecute financial crime, a trend that we expect to see increase further as a result of ECCTA. Can we just have the next slide, please? Thank you. So a brief overview of ECCTA and what it does. You may have seen the startling statistic published by the UK National Crime Agency that fraud represents 40% of all crime in England and Wales, and the UK has long been concerned that it is being seen as a hub for money laundering. Brought in to tackle the significant increase in financial crime and the perception that the UK economy was vulnerable to exploitation following Russia's invasion of Ukraine, ECCTA has added another weapon to the UK law enforcement toolkit to prevent the UK economy from being a safe place for dirty money. In essence, it seeks to punish a toxic criminal culture of turning a blind eye to criminality, or a view that this is just how business is done. Can we have the next slide, please? ECCTA has been rolled out in phases since it received royal assent in October 2023, with one of its major changes, the failing to prevent fraud offence, coming into effect in September of this year. ECCTA's main objectives are to prevent organised crime and terrorists from being able to abuse the UK economy, to give law enforcement greater ability to tackle financial crime, and to improve the reliability of companies' house data and increase transparency over the companies registered with it. So while ECCTA is the government's response to get tough on financial crime, when you look at the changes being brought in, and what it is also doing, in effect, is outsourcing some of that responsibility to business owners and incentivizing them to take an active role in preventing financial crime. We just have the next slide, please. So how does ECCTA help the government to achieve its objectives? It increases the availability of information to the Serious Fraud Office at the early stages when a report of fraud has been made. We expect that this could lead to a greater number of fraud cases ultimately being taken on for investigation. Companies House now requires more information from companies and has increased powers to query and reject the information provided. ECCTA is also given more teeth to Companies House, which will be able to bring criminal action for companies that fail to provide the information required. However, the two biggest changes are those that we're going to focus on today, and they relate to how an organisation, as a legal person in its own right, can be investigated and prosecuted for criminal offences committed by individuals related to that organisation. The first way is that it introduces a brand new offence of failing to prevent fraud. Fraud has historically been very difficult to prove against a company, but ECCTA brings in an offence with similarities to the failing to prevent bribery offence that has proved easier to prosecute since its implementation than other Bribery Act offences. But the second and perhaps bigger change is that it makes it easier for companies to be held criminally liable for the actions of its senior managers. Historically, it was very difficult to be able to attribute criminal liability to a company, but this is no longer the case as a result of ECCTA, and we wait to see how this is going to change the landscape of economic crime going forward. And with that, I'm going to hand over to Anna, who will talk you through those two changes in more detail.
Yes, thank you, Philippa. If I could have the next slide, please. Thanks very much. As Philippa said, the first way in which corporate criminal liability is effectively being expanded by ECCTA is by an expansion of what we call the identification principle under Section 196 of the Act. Now, essentially, in the UK, it used to be very difficult to get at the corporate mindset that you needed to establish corporate liability. Effectively, even though companies are not people, you need to be able to attribute an intention to commit an offence in the same way as you would an individual. And obviously, the way to do that is through real people. But how do you do that? Before, even where you had someone very senior within an organisation, even a sort of a CEO or a COO, and they were directing and having knowledge of criminality that might have been conducted within and through their company, you still couldn't get at the company and prosecute them for that criminality necessarily. Even when they're very senior, there were rulings that basically said that unless they had expressly, the board or the company had expressly delegated that power to take that action to those people, you still couldn't establish corporate criminal liability. The thinking was that this position seemed wrong, where you have very senior people directing criminality. Maybe we should be able to get at corporate criminal liability. And effectively, ECCTA does that. It legislates to fix what was perceived as a problem there. So how does it do that? So as I said, section 196 of ECCTA, it says that a senior manager of a body, corporate or partnership acting within the actual or apparent scope of their authority commits a relevant offence, and thereby the organisation is also guilty of the offence. So there it codifies that if you have a sufficiently senior person within the company that has committed a criminal act, for now that's just economic crimes, then they will also bind their organisation effectively and make them guilty of the offence. The relevant offences to which section 196 refers are broad, and we'll come on to that in a second. But as I say, at the moment, they are limited to economic crime, as well as attempts and conspiracies to commit those. Interestingly, this section under section 1963 also has extraterritorial effect, it has an overseas effect. So a company may be held liable if the offence committed overseas is also an offence in the relevant in the UK. It's the other way around. And a company may be liable if the offence committed is also an offence in the relevant jurisdiction. So if the offence is a crime overseas, it will also effectively be a crime here. And the meaning of senior manager is obviously the immediate question that comes to people's minds. Define senior, what does that mean? Effectively, that is yet to be defined, given that ECCTA is a relatively new piece of legislation. But at the minute, the guidance we have is that it will effectively be someone playing a significant role regarding a substantial part of the business. And the meaning of significant and substantial, again, I'm sure will be defined by case law in due course. If I could have the next slide, please. So as I said, the Schedule 12 to the Act contains the underlying offences to the Section 196 senior manager offence. So which offences, if a senior manager commits them, will bind a company with corporate liability. These are limited to economic crime, but they are quite extensive. So as you can see there in the list, we have fraud, fraudulent trading, false accounting and theft, bribery. So as Philippa mentioned, the Bribery Act previously having expanded corporate liability, we now also have it an easier way to find companies liable for bribery through the actions of their senior managers. Money laundering offences, both under the money laundering regulations, but also under the Proceeds of Crime Act, which applies to all companies in the UK. And then finally, that point there on the crime and policing bill, I've said a few times that this only applies to economic crime. There's currently a bill going through Parliament in the UK, meaning that if this becomes law, it will substantially expand the senior manager doctrine. So no longer just applying to economic crime offences, but applying to all criminal offences, much wider criminal offences. So we will see perhaps the same mechanism expanding much more broadly shortly. Next slide, please. So the second way, and again, as Philippa has already mentioned, that we will see a significant expansion to corporate criminal liability is in September of this year. As we said at the beginning, ECCTA has been rolled out in phases, some of which are already in force, like the senior manager principle, but some are still yet to come in, and this is one of them. So Section 199 of the Act makes it an offence that a company has failed to prevent fraud. And this sort of mechanism for holding a company liable follows similar offences that have existed under the Bribery Act and the Criminal Finances Act, failure to prevent bribery, failure to prevent tax evasion, and it works in much the same way. So you can see the wording of the legislation on the right. A body which is a large organisation will be guilty of an offence if a person associated with that body commits a fraud offence intending to benefit, and that's direct or indirect, the relevant body, unless, so it is a defence, to prove that at the time the fraud offence was committed, the body had in place such prevention procedures as was reasonable in the circumstances. So effectively, if you're a large organisation, and we'll come on to that in a moment, if a person associated with you commits a fraud and you cannot demonstrate that you had reasonable procedures in place at the time to prevent that fraud from being committed, the company can be found guilty of an offence of failure to prevent fraud. Next slide, please. So what is a large organisation? And this criteria is as follows. It is two of the following. So turnover of more than 36 million, a balance sheet total of more than 18 million, or a number of employees of over 250. This would apply in the preceding financial year to when the offence was committed. But we always caution, not being a large organisation is not the literal get out of jail free card here. First of all, we consider that it's likely that this will be expanded. There's no such large organisation limitation to the failure to prevent fraud offences under the Bribery Act or the Criminal Finances Act. And there was a bit of commentary at the time as this went through Parliament that this doesn't apply in other criminal offences. There was a comment from Lord Garnier at the time saying, what other criminal defence defines liability based on the size of a defendant? A small thief is every bit as much of a thief as a tall one. So we'll wait and see. We're not sure whether or not this will stay in place forever. But additional to that, you have to be mindful that this will be assessed on a group basis, first of all. So a subsidiary of a large parent will be caught by this. It's not each individual company, but rather the operations of a group as a whole that will be assessed for this purpose. And also large organisations, we suspect, will expect their associated persons to make undertakings that they have policies and procedures in place that are reasonable to prevent fraud. As you'll remember, the liability isn't just the company itself committing the offence, but also committing the offence through its associated persons. So companies will want to, if they are a larger organisation, retain a little bit of control in the sense of having that reassurance from their associated persons, even if they are not themselves large organisations, that they have put steps in place to prevent this from happening. So we caution that you don't read these thresholds and think, well, it doesn't apply to me. It may well do so. So who is an associated person? An employee, an agent, or a subsidiary undertaking of the relevant body. Those may be rather obvious, but also persons who otherwise perform services on their behalf. So those persons who are acting on behalf of a company, be that third-party intermediaries, potentially consultants, secondees, contractors, they can also bind the company. And this has been seen through convictions under the Bribery Act previously for use of third-party intermediaries, even overseas. And what are reasonable procedures? So that defence to the offence, oh, well, I had reasonable procedures in place at the time to prevent this from happening. What does that mean? What is reasonable? This is very much open to interpretation, rather unhelpfully, but there is Home Office guidance on this that was published in November to give clarification to companies on what they need to do. But the point is that it's not prescriptive. There's an expectation that policies would be tailored to the individual risk profile of companies. So if you are a particularly low risk company, perhaps the threshold won't be so high as to meet what is constituted as reasonable. But if you are operating in a very high industry risk sector or conducting high risk work, then perhaps the standard will be higher to meet what is reasonable to protect your business. And finally, in terms of its extraterritorial effect, we often have the question of, well, how does this sort of affect overseas companies? If there is a UK nexus here, so if an employee commits fraud under UK law or targeting UK victims, their employer could be prosecuted, even if the organisation and the employee are based overseas. So clearly the intention is that the offence will have a broad application, and we think this will apply to any organisation offering goods and services through a website, for example, or providing an internet marketplace that's accessible to consumers that are based in the UK. If the actions can affect consumers that are based in the UK, then you will be captured by the failure to prevent fraud offence. We can have next slide. I think I am now handing over to my colleague Paul, who will walk you through some practicalities there.
Thank you, Anna. I'm going to run through some themes of which businesses need to be particularly alive to developments in relation to ECCTA. And that starts with dealing with the high risk industry sectors. For example, businesses which operate in the financial services sector or real estate and construction sector, in healthcare and pharmaceuticals, and government and public sector in particular. And it's safe to say that businesses with links to the extraction sector, in some sense, all companies are in the scope of ECCTA, and in particular, businesses are in those different sectors. The OECD, interestingly, says 1 in 5 overseas bribery cases involves companies in the extraction sector to do with gas, mining, oil, and so on. Businesses which have higher risk clients and that may include businesses which interact with government agencies and politically exposed persons. There is Section 6 of the Bribery Act, for example, which specifically addresses bribing government officials. We've mentioned the extraction industries already, and businesses with clients which are rapidly growing. It's obvious to think about fraud and anti-money laundering, but in addition to that, you need to be alive to where clients, you might have an exchange of secondees, for example. Which company are they representing when they work for a client company, and if you have a mutual arrangements, the opposite is true as well. What about where your role is to actively represent a client in a higher risk area? And it's important to think about roles in the supply chain as well, your role in the supply chain, and if there is a chance that other entities in the supply chain may require access to your policies as part of their reasonable check procedures as well. High-risk jurisdictions. There are a number of resources that are available to check if you need to, whether or not a particular jurisdiction is higher risk. There is the Corruption Perceptions Index from Transparency International. The UK government has a UK sanctions list, and the Fraud Action Task Force in the UK maintains a list of higher risk jurisdictions in relation to anti-money laundering. So there are jurisdictions where there might be considered to be weak or non-existent enforcement of anti-bribery laws, or where there's often a veil of secrecy in the corporate structures, and they might be opaque. As we're covering today, there are businesses which will be more exposed to new offences, including failure to prevent fraud, and a raft of others, such as bribery, by virtue of the expansion of the senior manager identification doctrine. And of course, we need to recognise the practicalities of the law enforcement agencies who have these new powers with this new legislation coming in. They'll be expected to police this new legislation. The FCA has made combating fraud a central pillar of its strategy this year, and the director of the SFO has said that quote there, "Come September, if they haven't sorted themselves out, we're coming after them." That can't mean everybody, but the point's made there. Next slide, please. I'm going to go on to a new section now on with the advent of this new legislation and obligations, what needs to be considered in particular in relation to fraud and fraud prevention, so that you can be compliant going forward. And to start with, we'll look at Section 2 of the Fraud Act 2006, which is fraud by false representation. So that's where there is a false statement in that it's untrue or misleading with the intention to cause a loss or make a gain. So in practice, that would include, for example, sales representatives overstating the quality of their goods, selling refurbished goods saying that they are new, or claiming that goods meet standards when they don't. And it might be that there are overinflated or otherwise false invoices or overly optimistic financial forecasts to attract investment. But I think it's also worth dwelling on that, and it's not just traditional financial issues that might link to fraud. A pharmaceutical company could overstate the success rates of a drug to seek funding. That's a fraud, if that's not true. An engine manufacturer, which we've seen in the past, misstates emissions to compare compliant or to achieve a competitive advantage, would also be committing a fraud by false representation. Metal processing plant misrepresenting levels of pollution in wastewater, for example. Those are frauds as well, but not necessarily directly financial frauds. Such as billing for work that was never done. That would be a simple example. So there's also Section 4 of the Fraud Act, which here it's to do with exploiting a position of trust or an abuse of position, again, to cause a loss or make a gain. And that would include a financial advisor overstating or downplaying information on an investment product or market risk, and exploitation of vulnerable clients. And there is a direct link with an abuse of position and fiduciary duties that chimes directly with this section. So an abuse could easily be where a breach of confidentiality, a duty of care, a loyalty to the business, or to act in good faith would be an example of a fiduciary duty, and potentially where abuse of position might lie. So compliance regimes need to be adequately resourced in response to devise and maintain proportionate and reasonable controls that mitigate the risk of fraud. So if we can go to the next slide, please. We'll now look at some red flags to address when assessing those risks. Starting with frequent billing, expenses, or supposed mistakes or financial inconsistencies. So the important point here is the repeated nature of this, if it's frequent. So ignoring, for example, gifts and hospitality register requirements if you have a policy. And I would add, it's all very well having a policy, but if there's really a culture to ignore it and not use it, and it's repeatedly disregarded, or if the internal audit function might detect it, but nothing happens in response to what they note, it is ineffective. Then you can't really say that procedures are reasonable. It's all very well having a policy that looks good, but it needs to work in practice. You'd have to question if a failure to prevent fraud defence that I mentioned is actually accessible in that situation. Secondly, whether there's an unusually close relationship with a vendor or a customer. See this a lot in relation to COVID, for example. So there's shortcuts have been made because it's been difficult to tender out for particular goods or service over a longer time, got into bad habits, but never really remedied that and got back in to be aligned with policy, which might be to tender out over a certain period of time, or always tender to 3 different suppliers. But people have lapsed into bad habits. Only one supplier gets utilised, and they exploit that relationship. Thirdly, an unwillingness to share duties or excessive control, which indicates a lack of examples. So an example of that would be where the same person wants to order goods, receive the goods or services, authorise their payment. There's a lack of segregation in the roles. That would be a red flag. Sort of more subjective, I think, this one. The fourth one is about irritability, defensiveness when routine compliance questions are asked. So if someone has their own way of doing things, doesn't want to take leave or rotate their role, is their line manager active in sort of being alive to these sorts of issues, that's a red flag as well. If a request is made for a substantial amount of detail in relation to processes such as the internal audit function by an employee, without a plausible or rational reason, that could be to possibly identify weaknesses to work around if there are ineffective controls. Another one is employees making procedural computer system entries or inquiries not related to their normal duties, and it could also be that when they do that and where they do it. So if they're entering the building at unusual times or doing specific tasks out of hours, these are things that can be detected through data analytics, for example. There could be poor engagement with corporate governance, and that could be a person or a group. An indication of poor transparency arises from that when questionable ethics. For example, is there an effective, well-publicised and secure whistleblowing process? Are people using it? Unverifiable data, we'll come to some examples a bit later on, but a fabricated insurance claim could be an example of that, as well as the non-financial Section 2 fraud offences that we covered earlier. Another red flag, lastly, is to pressure to deliver good news. So it could be to do with a fee structure, and if there's a reliance on a revenue stream that adds pressure to arriving at a certain outcome, and the fee is relative to that outcome, that's another red flag where there might be a fraud potential. Okay, if we can go to the next slide, please. So here, I'm going to reiterate the point about the fundamental need to ensure compliance is fit for purpose and to increase its pervasiveness across an organisation. The title there sounds a bit glib, maybe, but it's very important that compliance is sufficiently resourced from top to bottom. And these link back to the principles in the guidance for the UK Bribery Act and the failure to prevent fraud offence both cover similar principles. There's 6 of them, which it's useful to familiarise yourselves with. There is an overlap between them. So let's start with embedding anti-bribery and anti-fraud procedures into commercial operation. And this links straight back to the first principle, which is the tone from the top. So there has to be meaningful senior engagement, ensures senior managers are aware of their particular risk exposure. Risk assessments will be needed, so that the compliance procedures are risk proportionate and specific. Policies and procedures are adequate and proportionate to the risk. So doing business in South Wales versus, say, South Sudan, very different propositions. Staff awareness of bribery and fraud red flags and the escalation process needs to be incorporated into the organisation. We've touched on the whistleblowing procedures. When it comes to the supply chain onboarding, an example of would be to add a clause into a contract with a supplier about what to do in the event that bribery is discovered, fraud is discovered, and similarly with third-party due diligence as well. Okay, in relation to training, again, this is led from the top. Training needs to be regular, revisited, monitored. The syllabus needs to be checked and tailored to specific employee risk. And a good example of that is senior managers. They need to know that they are senior managers and considered senior managers under the definition, or perhaps staff that work with intermediaries will need specific training as well if an intermediary is required to access government functions, for example. Updated in line with legislation changes and business risk changes. So as risk assessments are performed, it can't be a one-off exercise. They need to be revisited as the landscape changes. New governments, new regimes could come into place, for example, as well as new laws. So it's important that it's a living thing, risk assessments, and that they are incorporated into training syllabus and training programs, which are regularly updated. Okay, and next slide, please. So I've touched on hospitality. Again, these are useful examples, I think, in relation to making compliance more strategic and more prevalent throughout the organisation. So the hospitality and facilitation payments, these are prudent rules of thumb. We're really saying that there's no intention to induce or reward the recipient, and that there shouldn't be a perception of that either, in terms of, say, the timing of hospitality, and obviously it should be recorded for transparency. So there needs to be clarity in the line between acceptable corporate hospitality and bribery, no very minimal hospitality to public officials, being a notch of the Section 6 Bribery Act offence, and no hospitality during the tender process that could be perceived to be a facilitation payment. We put Companies House in there, so it's important at this stage to get on top of the admin. Companies House is ramping up its infrastructure. The number of people work there has increased substantially recently in the UK, and it has a raft of new powers and requirements. So the sooner you're familiar with those new powers and requirements, the better. So ensuring accurate, up-to-date and verifiable information about direct shareholders and registered officers on site. If they don't believe that the address is real, the address will default back to company's house's address, and that means poor credit rating and lenders look to your financial creditworthiness. That information will become more reliable, so company's house will be useful to conduct due diligence and third-party exercises like that, to identify and document beneficial ownership structures in client and supplier relationships. Okay, so if we go to the next slide, please. Before we go into case studies, I just wanted to stress that there are an overlap between the principles I mentioned earlier, and I would really recommend looking at those because, for example, top-level commitment to resourcing, training and compliance could be in response to a risk assessment, which also needs monitoring. So that cuts across 4 straight away, and they're all linked in that way. And the message is that no regulators and prosecutors will care if your policy is perfect. They care if it's real. So you need to align your compliance efforts to real business risks under both the Bribery Act and ECCTA. And that the benefits of that are protecting your company, your business, avoiding costly investigations, reputational damage, and potentially the loss of key employees. And in itself, by doing that, you can also unlock commercial opportunities you may not otherwise have. You can seem to be compliant and transparent. You may have more opportunities to conduct business with large organisations as well as public bodies. So if you like, your compliance footprint becomes an asset, if you like. Okay, I'll be quiet now and move on. We can move on to the case studies.
Yeah, thank you, Paul. We're going to take a little bit of time to go through some practical examples of how all of that applies, because I appreciate, even as lawyers, sometimes we look at ECCTA and we're looking at all the different sections and suddenly it all just becomes a little bit opaque. How does this actually affect a business in practice, and how should we be thinking about it operating perhaps within our business? Next slide, please. So as I say, we produced some example fictional case studies just to sort of walk you through how these sections that we've mentioned earlier can apply in practice. So the first one is that section 196 of ECCTA, which was the senior manager, the ability of senior managers committed economic crime offences to bind your business through their individual actions. How would that apply in practice? So here we have a company called Vita Products Limited. And so Vita Products Limited is a UK-based manufacturer of advanced surgical equipment for hospitals. Their core product is something called Synapse Tech AI. I can never get through a presentation without mentioning AI anymore, can we? A system used during brain and spine surgery. The key market will be NHS trusts, as well as private hospitals and international distributors. In 2024, Vita Products bids for a £30 million NHS contract to supply Synapse Tech AI. The Director of Government Contracts, so a senior manager, who is responsible for overseeing public sector tenders and strategic bids, again, that's a significant part of a substantial part of the business, orchestrates a scheme to misrepresent Vita Products' capacity in order to meet procurement thresholds. She knows that the company's product is only at the moment used in 9 UK hospitals, but she represents this instead as 25. She also submits false or edited reference letters from hospital procurement teams. And she says that the product has a certain safety certification that it does not yet have. This is still just in progress. This helps Vita Products win the NHS tender, which is subsequently uncovered when NHS staff check the underlying details and everything unravels. Next slide, please. So what can happen? What's the outcome from this? The Director of Government Contracts is convicted of fraud by misrepresentation for lying on the NHS application. That is in her own right, in her personal capacity as an individual. That's section 2, as Paul mentioned earlier. Fraud by false misrepresentation. Under section 196 of ECCTA, the senior manager, the Director of Government Contracts, committed the fraud during the actual or apparent scope of her duty. She was on the job, She was working in the capacity of the Director of Government Contracts. It wasn't in her personal life. It was in order to get this contract. And so the SFO investigates and commences a prosecution under Section 196 off the back of her conviction under Section 2 of the Fraud Act. Company is then held criminally responsible, even if the rest of the board did not know. So one senior manager could have been involved in this project, not just the rest of the board, and the company can still be found criminally responsible. Vita Products defends the charge, perhaps saying, maybe that this individual wasn't a senior manager, or there wasn't the requisite mindset there, but they're found guilty following trial. It is ordered to pay an £18 million fine, and it's barred from bidding for NHS contracts for 5 years. So this is an interesting point as well. There's a certain amount of interaction between ECCTA 2023, but also the new piece of legislation, the Procurement Act 2023 in the UK, which effectively consolidates lots of different pieces of public procurement legislation into one place, but also now brings the UK up to speed with perhaps some other jurisdictions that were doing this previously, whereby if a company is convicted of an offence, including economic crime offences, it can be put on a mandatory debarment list for a period of up to 5 years, whereby the company cannot bid for tenders for public contracts during that time. There's also a discretionary list whereby, clearly, just because you're off the mandatory list, it may be that another company can be chosen above you by reason of you having had a historic conviction for an offence like this. So if your business is very dependent on public contracts, for example, you have to be mindful of the interaction not only of ECCTA, but between the Procurement Act and ECCTA. Effectively, if you don't have great compliance, you're opening yourself up to not only a criminality under ECCTA, but also potentially being barred from bidding for public contracts for a long time, for up to 5 years. So this is what happens to Vita Products here, and clearly, given they're a company providing surgical equipment, this could be extremely damaging to their business. So with such a significant amount of its market base then effectively removed, reputational damage of having been convicted for a fraud offence, and with the fine to pay of £18 million, the company will now ultimately become insolvent and go into administration. This occurs regardless of the company's small size. So the company doesn't meet those large organisation thresholds earlier. That large organisation threshold only applies to the failure to prevent fraud offence. It does not apply to the senior manager offence under Section 196. So in some ways, the senior manager offence is even more expansive than the failure to prevent fraud offence. And it does not matter that the offence we mentioned here took place in 2024, because the senior manager offence has been in force since December 2023, so it is already in effect. If this is not something that your company has been thinking of to date, it does need to do so straight away, because we're already sort of coming up for 18 months of this being in effect. Next slide. We have one more case study that Paul will talk you through.
Yeah, thanks, Anna. I think the senior manager doctrine point that you mentioned before is really important from that example. The failure to prevent fraud is quite sort of relatively simple to understand, but if you look at the offences that the expansion captures, that isn't to be underestimated whatsoever, and the offences will only increase quite soon. And importantly, as Anna said, it's already in force. It came into force on Boxing Day in 2023, the expansion of the senior manager principle to capture and attribute their actions to the company in relation to financial crime offences. So that really is to be respected, I think. So this case study is to do with the failure to prevent fraud. So we'll go through it and we'll look for some things to be alive to as we go. So Blackmark Consulting Limited is a mining and energy consultancy headquartered in London and operate with operations worldwide. So we have a UK connection there straight away. They provide resource estimates, environmental assessments and feasibility studies used by clients to raise finance or sell projects. So as we mentioned earlier, fraud isn't just financial. So an environmental assessment, if it's misrepresented, could also be fraud. And we've also got there relevance to finance. So there may well be regulatory interest as well as law enforcement. In the future, in 2026, Blackmark is hired by Terra Gold PLC, a junior mining company listed on the alternative investments market, to produce a competent persons report, or CPR, for a gold deposit in West Africa. Two Blackmark senior geologists conspire with Terra Gold's CEO to deliberately falsify resource estimates in the competent persons report, exaggerating the quantity of gold reserves. As a consequence, this inflates the company's valuation before a major share offering. So if we look at what we've got there and look at towards the right-hand side, we can see that Blackmark has benefited financially. They earn higher consultancy fees and long-term work from Terra Gold. After a random site inspection from an independent mining analyst, it emerges that the gold grades were overstated. So that's where they've got caught by something unexpectedly happened. A whistleblower could do the same thing. The UK Financial Conduct Authority and the UK Serious Fraud Office launched a joint investigation. And these investigations aren't quick, I can tell you that. So that will take a long time, and that's all time that a business could be in the media and the reputation damaged. Their investigations discover that Blackmark have no controls, policies or procedures in place to effectively verify the accuracy of competent person reports issued by regional teams. The internal audit and compliance functions were non-existent for technical reporting. They found there was no clear communication from the business about what constitutes fraud and the expectations of the business. Top-down management approach. Senior management ignored warnings from junior staff questioning the emerging data. Next slide, please. So what were the outcomes of that? The FO charged Blackmark under section 199 of the ECCTA legislation, which is failure to prevent fraud, because Blackmark is a large organisation. And if you want to look at the definition again of large organisations, you can look in the sections that follow 199. They found fraud because a person associated with Blackmark, the geologist, committed fraud intending to benefit Blackmark. So they were associated, not necessarily an employee, but they were definitely associated. And Blackmark did not have reasonable fraud procedures in place. No controls to prevent it. Consequently, Blackmark is convicted at trial under section 199 of the ECCTA legislation, despite having no board level knowledge of the offences. It did matter. And it's ordered to pay a £25 million fine. The fines can be unlimited. The reputational damage is huge, and it's struck from public panels and blocked from many public tenders. Relates to the new the Procurement Act 2023. Multiple directors resign, so there's a loss of key personnel, and the position in the industry and generally is now in question. Question if it's a going concern at all now. No one wants to instruct a convicted fraudster, even when it's a corporation. So you can see from what was sort of a simple crime that the repercussions are massive, and that needs to be considered when doing risk assessment work as well. It's not just to consider financial loss, but what about reputational damage that a 5-year investigation might incur? What about the loss of key employees as well if the controls don't prevent a fraud? So it's important that risk assessments are done and monitored, and that their findings are incorporated in training programs as well as policies and compliance procedures. Okay, I think that is the end of the certainly the end of the second case study. So I'll pass back now to Philippa.
Yes, thank you very much to Philippa, Paul, and Anna for your insights. That was a really engaging presentation. And we'll now just move on to some questions that have been submitted from our audience. And the first one is, how do you assess the current readiness of UK businesses to comply with the failure to prevent fraud offence?
I'll try and answer this, Charlie, but Paul and Anna, do feel free to jump in if I miss things. But I mean, I think my view is they're just not quite there yet. When I go out to events and I'm talking to companies and talking to them about this, because apparently I have nothing else to talk about except for ECCTA at the moment, I think it's fair to say that, they're just not aware of the changes that are coming in or quite how far-reaching the changes are. And even those that do come and speak to us, they'll quite often think that, perhaps they can just, their Bribery Act policy might just cover things, or, they don't need to do much more. And, speaking to them and telling them about how far-reaching this is has really kind of generated a lot of conversation about the things that need to be done, and relying on what's in place is not going to be sufficient for them. So I think, there are also a staggering number of companies that we've spoken to that just don't really have economic crime policies in place. And, where they do, they're not necessarily speaking to each other or fit for purpose for these changes.
Anything else to add, Paul, Anna?
I think I agree. And I would also say that there's an opportunity for efficiency here. We see some businesses looking at bribery separately from doing fraud, and looking at their failure to prevent procedures as well. There really is an opportunity to combine and get your house in order now, before particularly the failure to prevent fraud offence is enforced from September. And there's an efficiency to be had in doing risk assessment work of that nature at the same time, I think, because yes, there is daylight, but quite often there's an overlap between some of the economic crimes caught by doing those risk assessments as well. So I think take the opportunity to do an efficient risk assessment now. But certainly, as Philippa says, there's much more to be done. I think people have cottoned on to the Companies House changes, which is half of ECCTA, but dealing with these crimes as well is still to be done. And don't take your chances, because a lot of this has been outsourced to companies, and the government and the law enforcement agencies will be actively policing them and making use of these new powers they have.
I think that's a really good point. And also, companies are now looking at their Bribery Act policies afresh, and realizing that, they're not the company that they were 15 years ago when they first brought these in, and they haven't actually dusted them off since. And so, it's a good opportunity to review what's already in place and make sure it's still fit for purpose for your business, that it reflects, any changes that may be relevant as a result of, recent case law, or, lessons that we've learned from DPAs or similar, and, to really address that now.
Okay, now our next question, which you've touched on slightly there, is how should boards be approaching financial crime risk assessment because of ECCTA?
I think it's very clear in everything that we've seen that there is an expectation for top-down commitment. So, this needs to be spoken about at board level now. You need to be recording it in your minutes of meetings, that this is on your mind, that you are taking positive action to do something about it. And then following on from that, it's the things that we've mentioned in the course of today's seminar. So, have a look at all of your financial crime policies. Do you have one for fraud? Do those policies speak to each other? Is your risk assessment up to scratch? Do you need to start thinking about, are you working now in new jurisdictions or new sectors that you weren't currently before, which have additional risks attached to them? And I think also the one that gets missed quite often is the whistleblowing policies, because that is something that, companies are being encouraged to look at, to think about. And again, it's worth just dusting that off now. Is it still fit for purpose? Is it being used? And if it isn't, is it not being used for the right reasons? And again, just making sure that all of those policies are working with each other. And, there are, Paul's mentioned the guidance from the government in terms of failing to prevent fraud. In fact, I would say that a lot of that guidance is relevant to ECCTA generally, the senior manager regime, and certainly putting some training in place around your team, around your senior managers, around third parties that are providing services to your company are all going to be beneficial, and should be things that are on the board's mind.
Okay, great. Oh yeah, sorry, go on, Paul.
Just going to add as well, at the top level commitment is really important, and it's important that training programs, compliance teams are adequately resourced. We can't do window dressing, you can't do a veneer of this, that people are alive to that. So if the compliance team is inexperienced, under-equipped, ignored, then there isn't top-down level commitment, quite clearly. So I think that's quite a key thing. You can't rely on other people's work, such as an auditor. It needs to be the board's commitment at the top, create the tone, and as Philippa said, don't just have a policy. The policies, bribery and corruption policy is one thing, but how does it work with the gifts and hospitality policy, with expenses, and so on? And make sure that the top level commitment is messaged, it's in board minute meetings, it's on websites, it's on annual reports, all of those sorts of things as well.
Great, and another member of our audience has said that it would be great to hear how data analytics or forensic accounting are used to detect potential fraud or financial misconduct under this new regime.
I think as I touched on, looking for outliers in sets of statistics would be an obvious one from that, and making sure that they're actively reviewed and regularly reviewed and acted upon. So in the examples that I said, why is someone coming in at the building or logging on from home at an odd hour with respect to the time zone that they're working to conduct their work? What's the explanation for that? There might be one, but there might not be. There might be a pattern. Why are two people logging on at the same time when they don't need to be in different parts of the world accessing systems that they shouldn't normally need to? So I think that would be an example of looking for outliers in reports of that nature, and seeing what leaks out and why.
I think on a less technical basis as well, the SFO recently published new guidance to corporates in terms of self-reporting. So if there is a concern, then it is worth getting in a forensic accountant to have a look at what's going on and whether there is a basis for the suspicion or the allegation that's come forward, because you will want to be considering whether there is something there, whether it needs to be self-reported to the SFO, and particularly if it's come through a whistleblower or a disgruntled employee or a disgruntled competitor, for example. You can't guarantee that they haven't made the report to the SFO or to law enforcement, and in which case it's better to get ahead of it than to be on the back foot. So as I say, the less technical answer, I suppose, but a way in which forensic accounting and data analytics can sometimes help to assess whether or not, a complaint or an allegation has some bearing.
Okay, we have time for one more question from our audience, which is, how does the new offence apply to solicitors conducting litigation on behalf of a client whose purpose is fraud?
So this is quite a difficult one, because we don't know necessarily what the assumed knowledge is of the solicitor who's acting for that client. But I think it's fair to say that there is a huge amount of pressure in the UK at the moment around professional enablers and ensuring that those of us particularly in regulated professions are not assisting. And in fact, the Legal Services Act has been amended to put in a new regulatory obligation, which is a positive obligation, to promote the prevention and detection of economic crime. So, I think we in regulated professions need to be particularly wary if we are aware that this is our clients, aside from, the professional obligations that are already upon us, if we think that this is our client's intention. And of course, there is a risk that, if the solicitor that's helping is in a role where they may be aiding and abetting fraud, that they are committing an offence themselves, and potentially, if they meet the criteria, their solicitor's firm. So potentially some really wide-ranging complications there.
Oh, sorry, Paul, did you have something to add there?
I was just going to add another example in relation to the fraud and data analytics. An example of something I was involved in was analysing exchange rates when a certain transactions were converted from one currency to another. And again, within that, you could see that the exchange rates weren't always what they should have been. And sure enough, certain when amounts were recorded on systems, another payment for the balance was paid to another account. So comparing those accounts, one could see that it was someone on the payroll was receiving money generated from using unfavourable exchange rates in the system. So that's another way you can analyse data exchange rates in that case, and look for where payments are then going, and realising that the beneficiary is actually an employee of the difference, which was a mistake, to say the least. But that would be another example from that earlier question.
Great, thank you. And unfortunately, that is just about all we have time for today. So I'd like to say thank you very much to our panel, Philippa, Paul, and Anna, for what's been a fantastic session. Thank you also to our audience today for your attention and for your questions. I hope you enjoyed today's session as much as we did, and we hope to see you all again very soon. I do encourage our audience to follow up with our panelists today for any additional questions you may have, or any information that you may require. Thank you and goodbye.